Welcome to Have You Read It, the channel where we bring books to life, one summary at a time. Today we're tackling John C. Bogle's Don't Count on It. Reflections on investment illusions, capitalism, mutual funds, indexing, entrepreneurship, idealism, and heroes. This isn't your typical finance book. It's a deeply personal reflection on Bogle's long career, intertwined with his insightful critiques of the financial world. Get ready for a deep dive into investment strategies, ethical considerations, and the very soul of capitalism. The book's title itself, Don't Count on It, sets the stage for Bogle's central theme, the dangers of blindly trusting numbers and projections. He argues that we often deceive ourselves with statistics, particularly in the investment world, where past performance is frequently mistaken for a guarantee of future returns. He challenges us to look beyond the surface of easily quantifiable metrics and consider the immeasurable elements of human nature, ethics, and wisdom in evaluating the financial world. Bogle begins by addressing the perils of numeracy, specifically pointing out how the over-reliance on historical data can lead to flawed conclusions. He uses the examples of long-term investment returns on stocks, often cited as justifying high expectations for future returns, illustrating how such returns are often presented in nominal terms, ignoring inflation, taxes, and investment costs. He makes the important point that past performance is not indicative of future results, emphasizing the role of both economic factors and investor emotions in shaping market returns. He highlights how even seemingly objective numbers, like corporate earnings, are often manipulated or distorted, leading to illusions of certainty where uncertainty truly reigns. He then discusses the optimistic bias that often clouds our judgment. We tend to project past trends into the future, failing to acknowledge that the sources of returns may change, or that there may be unprecedented events that disrupt all expectations. He notes how this bias affects corporate managers, who overstate their future prospects, and investors, who misjudge the actual returns available after factoring in costs and taxes. He cites calculations showcasing the dramatic difference between theoretical returns and those experienced by investors after factoring in the costs of financial intermediation, highlighting how the system often eats into a significant portion of investor gains. The book then transitions to a broader critique of capitalism, arguing that the recent financial crisis exposed fundamental flaws in the system. Bogle contends that the faith in self-interest and free markets as self-regulating forces has been shattered, illustrating how unbridled speculation can lead to systemic instability. He discusses the failure of capitalism, outlining how the broken circle of corporate greed, the failure of gatekeepers, and the shift from an ownership society to an intermediation society all contributed to the crisis. He uses numerous examples of corporate scandals and accounting irregularities to demonstrate how self-interest, unchecked, can corrupt the system and lead to harmful consequences. A significant portion of the book focuses on the mutual fund industry, an area where Bogle has dedicated his career. He argues that the industry, despite its name, has largely failed to live up to the concept of mutuality, that is, funds being truly owned and operated in the best interests of their shareholders. He highlights how the industry's structure, with separate management companies often driven by their own profits rather than shareholder interests, has led to high costs, poor investor returns, and ethical lapses. He contrasts the traditional alpha model of a truly mutual fund with the prevalent omega model characterized by external management, showcasing Vanguard, the firm he founded, as a successful example of the alpha model and its benefits. Bogle's critique of the mutual fund industry includes detailed analysis of cost structures, illustrating how high fees, sales loads, and excessive portfolio turnover significantly reduce investor returns. He presents data and charts showing the substantial gap between market returns and returns actually earned by investors, emphasizing the often overlooked relentless rules of humble arithmetic. He repeatedly stresses the importance of low costs in maximizing investor returns, contrasting this with the industry's focus on asset gathering and marketing. He also explores how the industry's structure, with external management companies, often leads to conflicts of interest and a lack of focus on shareholder needs, especially highlighting the issue of fiduciary duty. He urges the industry to adopt a more shareholder-centric approach, advocating for greater transparency, lower costs, and a return to the traditional principles of stewardship. A significant portion of the book is devoted to indexing, Bogle's champion investment strategy. He argues that indexing provides a simple, effective, and low-cost way to capture market returns, avoiding the pitfalls of active management. He emphasizes the intellectual basis for indexing, citing both the efficient market hypothesis and, more importantly, the cost matters hypothesis, which highlights the inevitable loss investors incur due to the costs of active management. Bogle makes the point that even if markets are inefficient, investors as a group will always underperform the market due to these costs. This is a key argument for the superiority of indexing. He traces the history of indexing, from its initial rejection to its current acceptance. He chronicles Vanguard's role as a pioneer in the index fund industry, describing the challenges and controversies involved in establishing the first index mutual fund and showcasing Vanguard's success as a result of its unique structure and commitment to low costs. He also explores different approaches to indexing, demonstrating how different methodologies can reach similar conclusions. Bogle then explores the topic of entrepreneurship and innovation, arguing that while innovation is essential for economic progress, it can go too far. He distinguishes between valuable innovation, which creates wealth or social welfare, and harmful innovation, which increases costs and risks without commensurate benefits. He discusses how financial innovations, such as complex derivatives, while often lucrative for their creators, can ultimately harm investors and destabilize the system. He contrasts this with the valuable innovations that have served investors well, citing examples such as money market funds and Vanguard's own unique structure and index funds. He further highlights the need for a balance between entrepreneurialism and traditional values like prudence, stability, safety, and soundness. The final part of the book focuses on idealism and the new generation. Bogle emphasizes the importance of idealism in business and urges young people entering the workforce to prioritize ethical values and the pursuit of meaning over mere financial gain. He provides guidance on various aspects of leadership, character building, ethical decision-making, and the importance of having a sense of vocation. He uses quotes from literary figures, philosophers, historical leaders, and religious texts to underscore the importance of purpose, integrity, and social responsibility. Bogle repeatedly emphasizes the importance of fiduciary duty, a central concept throughout the book. He criticizes the failure of corporate managers and institutional investors to prioritize the interests of their clients or shareholders. He argues that the financial crisis was largely a result of this failure to uphold fiduciary responsibilities, advocating for a fiduciary society where such duties are strictly enforced and prioritized. Throughout the book, Bogle uses the story of Vanguard as a case study to illustrate his points. He details the challenges and successes of creating Vanguard's unique structure and implementing its low-cost, shareholder-focused investment strategy. This serves as a powerful example of his own entrepreneurial spirit and commitment to his values. He reflects on the lessons learned throughout his career, highlighting the importance of luck, persistence, and a clear vision. The book also features personal anecdotes and tributes to mentors who shaped his values and career. The book concludes with a call for reform within the financial industry and society as a whole. Bogle advocates for greater transparency, lower costs, and a renewed emphasis on ethical conduct. He urges institutional investors to exercise their power responsibly and become more active in corporate governance. He also emphasizes the importance of investor education and awareness, empowering individuals to make informed decisions and demand higher standards from the financial industry. What are the main takeaways from "Don't Count on It"? Past performance is not indicative of future results. This is perhaps Bogle's most persistent and crucial message. Don't base investment decisions solely on historical data. Consider current market conditions, costs, and inherent uncertainties. Costs matter. Bogle relentlessly emphasizes that high investment costs eat into returns. Choose low-cost options whenever possible to maximize your net returns. This is the core of the cost matters hypothesis. Indexing is a powerful strategy. Indexing, with its low costs and broad diversification, offers an effective way to capture market returns. While not foolproof, it minimizes the risks and expenses associated with active management, often outperforming actively managed funds. Fiduciary duty is paramount. All financial actors, managers, directors, and advisors, have a duty to act in the best interests of their clients and shareholders. The recent financial crisis highlighted the devastating consequences of neglecting this responsibility. Idealism matters in business. Bogle champions the idea that business should be a calling, combining profit generation with ethical considerations and social responsibility. He urges young professionals to prioritize values and purpose alongside financial success. Some easily remembered heuristics from the book. Remember the relentless rules of humble arithmetic. Gross return. Costs x net return. Always consider costs. The 4 E's. The greatest enemies of the equity investor are expenses and emotions. The CMH. The cost matters hypothesis. The costs of financial intermediation will always reduce investor returns. Focus on long-term investing. Don't chase short-term gains. Consistent long-term strategies are more likely to succeed. Be a vigilant steward. Uphold your fiduciary duty. Prioritize the interests of your clients above all else. Thanks for watching. Make sure to give this video a thumbs up and hit that subscribe button so you never miss our next book dive.